Thanks for tuning into Profit Insights. We've heard a lot about how expensive equity markets may have become. And we also heard sporadically from people who look at various asset classes about how asset classes move in cycles. And if there's a particular asset class which might be in the wrong quadrant on the valuation front, there will always be options available. Now, usually we talk to equity investors. I thought it's very good at a time like this to try and talk to somebody whose brain, according to me, is probably wired to think of different asset classes at different point of time and investing based on how he believes the cycle is going to move and therefore choosing the asset class accordingly. And he will tell you that equity is not the only game in town. Our guest today is Maneesh Dangi of Mosaic Investing. Maneesh, so good having you. Thanks so much for taking the time out and being with us.
My pleasure.
Now, Maneesh, we talk about equities all the time, but every time I read your LinkedIn post, right, or occasionally see a social media post from you, I realize that you are trying to think of asset classes and how they behave in different cycles. Can you tell us why do you do that?
The cyclicality is the nature of being, you know. Everything, not just markets, but any system moves in a cycle. And the way it operates, of course, is that there are booms, there are stagnations, and there are bursts. And it's just not, as I said, assets, you know, even economies. They accelerate, as we've seen in India, let's say, for the last 3-4 years. There's sort of signs of moderation right now. Very likely, almost, you know, it's a truth that there'll be some slowdown in next 6 to 12 months' time. So if economies and corporate performance move in cycles, of course, asset classes also must move in cycles.
Got it. So if that is the case and if that is the hypothesis, then you are, I'm presuming, saying that, let's say, equities as an asset class may not necessarily be best or prime position for the risk-adjusted returns that they usually give, because that's the nature of equities versus some of the other asset classes.
That is true. So if, let's say, if we were to divide a cycle into early, mid, and late cycle, and cycle essentially means economy accelerating or business cycle accelerating, stagnating, and sort of slowing afterwards. It's best bet to buy equities if you know for sure that it's an early cycle, right? Meaning if you are entering in a regime where the more cars are getting sold at a faster rate, so acceleration, or imports are growing faster, or other discretionary stuff that we all buy are growing faster, it sort of makes sense to be into equities, you know, purely from a cyclical standpoint. And then, of course, if you're a mid-cycle, then it makes sense to be in credit because balance sheets are clean then. And even though the profit's slow, it won't hurt credit much. And in the late cycle, it kind of makes sense to buy bonds because very likely bonds are already elevated. And at some point in time, for the fear of slowdown, RBI or Fed would cut rates. So therefore, there'll be benefit from bonds. So because the bonds will rally. So early cycle, mid-cycle, late cycle, think of it like that. Early cycle, if you know for sure, then you must be overweight equities. Mid-cycles, you should be overweight credit. And late cycle, you should be overweight bonds.
Where are we in the cycle right now, according to you?
So now, again, we're sure that we're not in early cycle. You know, and the way to look at it is a little bit of a dipstick, right? That have we had good times in last 2, 3 years, 4 years? Yes. After COVID bust, you know, there's been a significant acceleration in economy. Is economy at margin accelerating anymore? I mean, are we getting surprises on the higher side in terms of growth numbers of PV sales or GDP growth or import growth or GST? Answer is no. So we are certainly not early cycle, okay? Now, there is a bet between are we a mid-cycle or a late cycle. It seems in US they are late cycle, okay? And India, you know, somewhere between mid or late cycle you could call in terms of economic state of affairs.
Okay, Manish, just a tangential question, but if I'm calling US the main mother economy because it's still the largest economy and what the Fed does, others take notice. I'm just trying to understand, just tangential to the conversation that I'm having, I'll come back to that. But if the US is in a late cycle, if the Fed were to embark upon a series of rate cuts, etc., what kind of an impact does it have on other economies let's say for India, which may not necessarily be in the late cycle, but is in the mid cycle? How does India therefore follow suit, or otherwise what? Can the central bank do something different than what the US central bank is doing, because we are in a different stage of the cycle than what the US might be in?
So because you call US mothership, the way to think of it is that it's every other economy, maybe outside of China, is super levered on US. So the impact that you see in US instead of is significantly more that you see in India, Indonesia, or any other country. Okay, that's one basic framework. So if the US is going to slow, it will certainly hurt India or rest of the world, even though every time you call it that we are now different, it never is, because in US is a marginal buyer of goods. So if your question is that if US is going to slow, would India too will slow? The answer is yes, it will. If Fed cut rates, would India cut rates? Answer again is yes, because that is the main thing that the RBI is looking for, not necessarily local growth inflation conditions, but enabling conditions should be in place for emerging market or India to cut rates. If Fed or ECB actually move along in cutting or dropping rates, it's likely that India would also find an opportunity to cut rates. So remember that India inflation is already at 3% core. So you already have a lot of space, and yet RBI is still relatively very hawkish. Only reason is not local economy is very strong. The only reason is that Fed hasn't yet sort of blessed us with a rate cutting environment.
Got it. So then the follow-up is, and I would love for you to distinguish for some of the people who might not do this very clearly, the difference between credit and bonds per se. But you mentioned that mid-cycle is credit, late cycle is bond. And late cycle is when the rate cuts start. Now, we may not be in the late cycle, but if the Fed cuts and if the RBI is forced to cut, let's say, then does it make bonds as an asset class more favorable versus credit, or that it's not a correlation like that? Also, just explain, how do people invest in credit versus bonds, because bond investing now has been made relatively easier by virtue of the platforms that exist as well.
So equity, you understand, it's mostly a bet on P&L, right, of a profit of a firm. So in some sense, it's a bet on the residual, as I call P&L. Credit is actually a bet on balance sheet of a firm. Now, balance sheet essentially means that whether the balance sheet has enough assets that can absorb shocks and has ability to repay, even if, let's say, overall revenues were to drop. And then bonds are actually bet on inflation. So inflation is certainly down, and therefore you can bet on inflation right now. Thereby you can actually bet on bonds. Bonds will drop. I am calling out that it's likely that the profits will not do well over next couple of years, 1 or 2 or 3 years, versus market expectation. But because Indian balance sheets are squeaky clean, for good 15 years, there has been sort of some form of deleveraging sort of playing out in India. Okay, so it is amazing. Even if it is late cycle, then also the markers of a late cycle in balance sheet, or let's say rating downgrade standpoint, has not yet kicked in. The leverage ratios in Indian corporate that we track, the leverage is debt equity, is at one of the lowest level in last 40 years. The margins are at 15-year high. The coverage, which is how much interest is there for you to pay to repay the debt payment, or DSCR, are at very, very high level. So basically, the balance sheets are super strong, and their ability to absorb what you call shock is very high. So kind of think of it like this, that if a AAA company, okay, you were to face a recession, it would still very likely remain AAA because its leverage was very low. What has happened in India is that today, a A-rated company is the financial specs of the balance sheet of it is actually closer to what it was for a AA company 5 years ago. So A is mimicking the performance of AA. So in some sense, the entire landscape of what you call balance sheets in India, mid or large balance sheets, has been lifted quite dramatically. And which is why I say that it's a safe call to take, even if we are in late cycle, though I think we are a little bit of a mid to late. to actually bet on balance sheets from a credit standpoint.
Okay, okay. Now just tell us, so therefore, are you choosing to do that? I mean, because you firmly seem of the view that we are definitely not in the early cycle, as data would suggest, mid or late cycle, and therefore, as an asset manager, and congratulations on Mosaic Asset Management, by the way, but as an asset manager, are you choosing to bet on credit or bonds or other forms of fixed income or non-equity asset classes at the current point of time?
So there are two things. One, I'm asset neutral. In a sense, wherever, as you said, wherever is the juiciest part of the market is where I'll bet on. And I think the juiciest part of market today is credit. So the answer to your question is yes, that is what investors should do, and I am doing that.
Why so?
Look,
why the juiciest? That's my point. You've given us some preamble, but why is it the juiciest part?
see, let's compare equity and credit, and then sort of figure out what kind of risk premiums or extra returns that you can earn from credit. Equity over long periods of time, if you are invested for 20 years or thereabouts, earns about 5% over bonds. Okay. Now, even if you're, let's say, invested in US for 100 years, in India for very long, you will get that much only. And I'm assuming if equity is fairly priced, right? Now, if you were to invest in a decent credit fund, let's say call it performing credit, fund, one of the funds that we will be launching soon, you would also get about 5% extra over bonds. Okay, so in a sense, there is a return parity between a credit risk fund and return of a equity over a long period of time. Okay, but there is a catch here. The catch is that if you are an investor for 20-25 years, it is true. But if you're an investor for 3.5 years, which a typical investor is, then the equity risk premia is only 50-60% of what is available for a long-term investor. You get my point? That because equity is very volatile, on average, if you're a 3-year investor, in last 20-25 years, you would have earned only 3-4% over bonds. So that risk premium for a short duration investor is actually very low. Whereas credit in itself is a 3-4 year duration product. So therefore, whatever risk premium is available to it is available for a 3-4 year investor.
Got it.
Third thing is that as of today, as I made an argument, the balance sheets are super clean. So therefore, you can easily bet on them for the kind of 4-5% risk premium that you seek. But equities are, one, expensive, and perhaps we are entering in a mid or late cycle, and therefore the possibility that the earning growth will not be very high is there. So it's likely that equity risk premium, the premium or the excess return that you earn over bonds, remember that, ERP we call it, is more likely 3% over long-term investor as well. Okay, which is 10-15 year or sort of long investor as well. So for next 3 years, I think the equity risk premium can be terribly low. Versus, because balance sheets are squeaky clean, you will earn 4-5% easily in credit. So which is why put all of these together and then look at the balance sheets of corporate, the upgrade and downgrade ratios of corporate. I kind of think that it makes sense for investors to bet on credit right now, to bet on the balance sheets of the company, instead of bet on equity to bet on the balance sheet. So you are actually, see, in sovereign bond, you are betting on sovereign. But you say, no, I want to earn that extra return. The way to do it is either buy a bond of firms or buy equity of firms. I think it's a time to buy bond of firms instead of equity. And within that, I think because balance sheets are so clean, as I said, remember that the A-rated company right now, the financial specs of it are equivalent to AA. So therefore, you can go down the rating curve, earn that extra 4-5% instead of actually buying only AAA.
Got it. So I just want to simplify this, viewers, and Maneesh, correct me if I'm wrong, but I think the point is that in the regular lingo, the risk-adjusted returns, I mean, you invest in equities because you expect a higher return, but you take a higher risk as well. But presumably in the current cycle, and Maneesh, correct me if I'm wrong, the quantum of risk that you have to account for earning an X amount of return is much higher because of all the factors spoken about and the cycle that we may be in relative to credit.
That is true. So equity, as can be observed through the price action. Every day upar niche, so standard deviation of 18-20%. So if you are a 3-year investor, you will experience a 13-14% standard deviation. We call it volatility.
Yeah.
But if you are, let's say if you had invested in my credit fund when I used to manage or any credit fund, the standard deviation for a 3-year rolling return would be more like 3%. In a closed-ended fund, of course, there'll be no volatility at all. So the walls are very different in two asset classes.
Right.
Whereas there is a risk parity. There is still a catch there, because if you are a very long-run investor and plus you have a tax shield in equity, it makes sense for a 15-20-year investor if the pricing or the valuations are at fair level.
Yeah.
Right now, I think everything is a little bit upar niche as far as equity is concerned.
Yeah. And why, and you mentioned the balance sheets are squeaky clean. So, right, why is it, therefore, that a credit fund product might be able to get the best bang for the buck? Because a lot of corporates that we speak to, for example, are either, because the balance sheets are squeaky clean, able to raise money from traditional sources of financing. The banks are hungry to lend, but their corporates not taking money. So where would the opportunity be for a credit fund vis-a-vis, considering the fact that a lot of options are available for the squeaky balance sheet to borrow from?
So basically, if it's a business as usual borrowing, the very balance sheet will borrow from bank at 10%.
Right.
Okay. But in credit, you sort of make returns from 2 or 3 things incrementally. One is excess, that there are certain kind of trades which are not available, to public at large, or regulatory arbitrage, that trades that banks are not allowed to do or mutual funds aren't allowed to do, or even NBFCs now are somewhat disallowed, or at least discouraged to do. So those are regulatory arbitrage assets. So through these two mechanisms, excess and regulatory arbitrage, there is small opportunity, and it's not very large. It's 40-50,000 crore, 60,000 crore perhaps annually. So for the size of economy, it's a very small opportunity, but available to only few people, or only to certain professionals who have access to such trades. Relatively short tenor opportunity, 2, 3, 4 years, and they are available at equity-like returns. Why promoters are borrowing there? Because in their mind, they're substituting equity. Okay, in their mind, they are doing this because they are getting tax shields. Okay, while investors experience that the equity is a superior asset class from the vis-a-vis bond because they have to pay lower tax on capital gain. But if some companies has to raise money, it works the reverse because they get the tax shield because it's a tax adjusted. The net expense, even if you borrow at 15%, it's actually 11% to the company, net of taxes. So therefore, it sort of makes sense for a short tenor, something instead of raising equity, promoters actually end up borrowing money at 14-15%. So in a sense, the trick is to have access to certain trades, exploit regulatory arbitrage, and on top of it, actually, since promoter also see value in it, so it's kind of becomes a win-win-win trade for everyone.
Okay. And you reckon that, I heard you say somewhere in the interview before that it's a 5, 6, 7 year window, if I'm not wrong, for this. So you reckon that we are at the start of that cycle right now on the credit side, and this could therefore last for maybe the next 3, 4 years or 5 years?
So see, balance sheets take time to decay.
Right.
In a sense, think of it like this: if a firm's revenue fall by 4-5%, the EBITDA, the operating profit will fall by 20-25%, and the PAT will fall by 35-40%. So there is a significant leverage. The profits leverage on revenue or cost of goods sold is very, very high. Okay, so because balance sheets are very clean right now, even if, let's say, bad things were to happen to economy over the next couple of years, they'll take time to decay. Eventually, as we began, that everything is a cycle. A good credit market, 4-5 years out, will likely give into a bad credit market when there would have been exuberance, mispricing of assets, and corporate would have again levered up significantly in the pursuit of more capex, more capacity. maybe that would be a time, we will be talking to each other and I'll be arguing against it. It's just that despite such high margins, if corporate capex is not kicking in a significant manner, it is a bad news for equity, but it's likely a good news for credit.
Got it. Okay. What about when will the turn of bonds come? Because I remember you telling me maybe a year and a half ago that it might be a good idea to start exploring global bond structures, because at some point of time the Fed will correct. The Fed is on the cusp of correcting. Some of those ETFs may have done really well. I'm just trying to understand from an Indian context, when do you think that turn will come?
I think India, for a treasury investor or a risk, the one who does not want to take any risk, balance sheet risk or P&L risk, it sort of makes sense for him to be long bonds. I have made this argument.
Currently?
Currently also. Indian inflation is super depressed, and given that you've already discussed about Fed's potential reaction function over the next 6 to 12 months, I guess we are headed to a super low interest rates in India in next 2 to 3 years. So I wouldn't be surprised if we get to 5 handle on 10-year bond, maybe 5.5% or thereabouts. There is a lack of growth in India that I see, and the biggest marker of growth, perversely, is actually inflation. So if core inflation is 3, they should be asking where is growth. So you know what? We seem to believe that we are accelerating in terms of growth, but then question that one must be asking, that why are we behaving like China in terms of inflation? Certainly US and Europe overheated, and they had massive inflation. Why don't we have it if we've also accelerated? So in a sense, a lot of growth that we made an argument has happened to the creamy layer, and then underlying economic momentum actually has slowed quite considerably. So my sense is that this would pave way for significant amount of rate easing, Neeraj, over next 6 to 12 months or 18 months.
One macro question before we wrap up, or maybe a couple of questions. Could we get into a scenario, Maneesh, wherein CPI, because the CPI is a focus of the political powers, because they don't want to hurt the vote bank with inflation, that CPI is under control, but economic growth and WPI tend to move higher and corporate profits move alongside. Could something like that happen over the, say, next 2, 3, 5 years? Because hitherto we have this hawkish, an eye of a hawk on inflation, and therefore all that's happening, plus the fact that you said the Fed hasn't blessed us. Could we move to a scenario like this?
So I kind of would take this question with this basic premise that I have, that the biggest elephant in the room today is China and China deflation. China is the kind of overcapacity China has today, even though everyone talks about it, always been so, I don't think it's ever been in the past, is that kind of overcapacity. So if you are an investor in anything, what should shudder you and what should keep you awake is that what if a rerun of 2014-15 plays out in China again? China is slowing, but China's overall capital block, its capex, its total output is actually still growing. It is dumping across all industries, high tech, low tech, mid tech. So my sense is that the bigger fear that one should have in mind is the fear of deflation instead of inflation. And please remember that as far as equity is concerned, its biggest enemy is deflation. No, inflation not an enemy. The bonds enemy is inflation. Credit does all right in both, relatively all right. Deflation, of course, not good, but a good balance sheet can absorb deflation. Inflation is decent, is very good for credit. It's not bad at all. But my fear is that in next 1 to 2 years, it's not going to be Russia, Ukraine, or oil. It's about how China deflation actually works its way into our economy or any economy. And that could be a very bad news. So I think I would caution, this exuberance that exists in manufacturing. I think I'm taking a detour now, but we should be extremely cautious manufacturing India right now, because the risk, especially the ones which are adjacent to areas where China has built large capacity. So even though you may have large amount of custom duty and stuff like that, we will have a way to, get goods in. And the prices at least enter, asani se. If, your neighborhood in Malaysia and Singapore, or Indonesia, things are selling super cheap, some way it'll actually enter India as well. So I wouldn't be worried of inflation right now. I think a bigger fear I would have in my mind is deflation.
On that note, Maneesh Dangi, Mosaic Asset Management, thank you so much for joining in today and giving us your thoughts. Really appreciate your time on Profit Insights.
Thank you.
And viewers, thanks for tuning in this very, very informative episode of Profit Insights.